Hello and welcome to week number 4, previewing what's lying ahead of the week. Actually, this week we'll be covering the next week and the following week, as I won't have a video for week 5. Starting off by having a look at what happened last week to the yen pair. So last week's review we had that after the PBOC meeting, so the People's Bank of China, yen pairs tend to gain momentum. And that's really important for us as traders, so we're not stuck in ranges for too long. So identifying that was really key. As you can see, most part of the week I wasn't really doing a lot. So here I started chopping about, and then come the PBOC meeting, and all of a sudden GBJPY tanks more than 200 pips. And that unlocked a lot of moves for all the other yen pairs as well. So here, for instance, it was chopping about AUD/JPY. After the meeting, it starts tanking. That was really important to find out when these moves happen. Directional call was a bit easier to do as we had yield curve guiding us, and all in all was a really solid read on the market. But starting off this week's analysis by having look at the CFTC data. This one is compiled by Scotiabank, so we've got a bit of data reading through it. Also can see the last 4 weeks. Something incredible is happening with Euro right now is that Euro longs are adding positions pretty much consistently every single week. So pretty much all this year there's just buyers, where the sellers are continuously squaring their position. Good thing is the open interest is staying elevated. That's really important for us traders, so we know that momentum is there. If this starts declining, we know, okay, people don't want to be in a market. But this is a good market. People want to be engaged. People want to build positions. Open interest is increasing. Net position on Euro is quite now positive. So the gray line here is the positioning. But EURUSD itself hasn't reflected that. And I'm going to get into that why EURUSD hasn't moved up. And I'll also explain to you why longs are building up. On the other hand, we have GBP. See, something happened last few weeks with GBP was there was incredible big short position build-ups, over 4 billion. That just kept getting reduced until we're about net, near to net, I would say. This is about neutral, so maybe a few contracts below or above zero won't really necessarily give us what the mood is of the market. But again, we had the same scenario where short's been covering, long's been adding. How open interest dropped a little bit. So with GBP, we had the reflection of price and positioning moving nicely, where with EURUSD it was very dotted. And one of the reasons GBP really went like that the way it did is because interest rates are increasing in the UK, and traders are starting to reflect that. The short position started getting cold feet, and they all rotated out of their positions. Now, going ahead for the UK, there's a couple of things going on. One is the economic outlook isn't as bright as it was probably when you were looking at December and beginning of January. So rate increases could not necessarily mean we're going to have a higher pound against US, specifically because the Fed is raising rates as well. So maybe we're going to be, depending how the positioning works out going for the next few weeks, the long move here is pretty much over for now. And the next leg, lower or higher, will then be determined by what the economics outcome is going to be. But with EURUSD, we right now have long build-up, which are vulnerable if, not next week, but the following week, the ECB doesn't deliver. Next week, the Fed is pretty clear what they're about to do. Everybody got a good understanding. We're going to talk about when they're raising interest rates, how many times they're going to do it, and at some point down there, they're going to talk about reducing the balance sheet. What we're not sure that what the ECB is going to talk about in 2 weeks' time, if they're going to be as hawkish as market is pricing. Right now, market is thinking about price. I think it's about they're pricing about 1 rate hike by the end of the year by the ECB. In 2 weeks' time, we need the ECB to say that. We need them to say, look, yeah, we're looking hawkish. This inflation is getting out of hand. We've got to do something. So then these positionings are warranted. If the ECB disappoints, at the very slightest, all of this is going to go back to zero. And you know where EURUSD is going to be. It's going to easily drop to 110 once that positioning unwind happens, and then short's going to get more aggressive again. So we're going to have we're going to have some pivotal moves going into February. But for now, I'm not expecting anything more than chop. Moving on, last week I did actually trade EURUSD. one of the main reasons I traded it and on the short side was because of the short-term yield differentials between the US and Europe. So the big move actually came quite early in the week. I missed that out. And then we had the sort of these ranges, by the way. So that's a Monday London fix, Tuesday London fix, very pivotal throughout the week. And then we had this little bounce here, which I used to trade on the short side. So I'm trading on the short side. We had a bit of wriggling about. I wasn't worried. I finally get the dump overnight, so I'm quite confident this is good. However, there was one small thing that happened in the market, and it's called an imbalance after the London fix. So the London fix is a 4 o'clock fixing between the banks on their fixed FX prices. So something happened, and there's a pattern which I've seen many times before. Is if the let me go down to the hourly because it makes more sense, and I speak so much more about this in my course and the London fix strategy. But more to that later. So at 4 o'clock you have this London fix, and it creates a candle. And over 70, sometimes 80% of the time, you do see the London fix tagged again. So now I'm trading here about at night time, right? And I'm thinking, oh, it's good. We're down about 30, 40 pips, and I'm looking for lower levels. And I'm thinking, okay, I should be able to get them. Macro is on my side. But I'm seeing this untagged fix here, and I'm thinking, this is no good. This can turn easily back onto me. And without any significant news. Funny enough, that's exactly what it did, and it took me out at the break-even price, really, pretty much. That was one of the trades where you think, oh, maybe I should have taken profit when I see this evolve, but you also knew the narrative, so I took a risk at that point, and it didn't play out. It's a bit of a déjà vu because we had a similar scenario not too many weeks ago. That was just one of the trades, but one of the key reasons why I believe EURUSD is headed for way lower levels from here is when I plot the 2-year yield of Germany against the 2-year yield of the US. And why do I do that? I do that so I can just express what the rate differentials gonna be between the ECB and the Fed. Fed is way more aggressive on monetary policy right now than the ECB is. ECB maybe in 2 weeks' time think about talking about raising rates maybe once, but the Fed is pretty much near to committed to raising rates, maybe even at every single meeting. So 3 to 4 hikes already priced in, and so it's way more aggressive. And you see the yield differentials, showing that. This is a picture perfect. This is a textbook of picture perfect representation of where the Fed is and where the ECB are. So your monetary divergence is perfectly priced in these yields. The good thing is EURUSD follows these yields eventually. Sometimes it whims about and it does its own thing every now and then, but in big picture, let me go down to maybe weekly so you can see it much better. Sometimes you get where EURUSD actually drops before the yields, because basically the yields, it's a bit more of a mechanic where we know where they're headed. And there's at times where EURUSD will peel away, like here in 2017 when the French election was and also ECB turned extremely hawkish. But then they changed their mind and EURUSD started converging again. Here we had the recession. Yield differentials went in Euro's favor. After a little bit of boxing about, EURUSD did actually climb over 1,200 pips. And now we're in this scenario where yield differentials are incredibly in favor of USD. But EURUSD is playing about still. I'm very confident that EURUSD will continue dropping for the rest of the year. So you might see maybe 50, 100 pip up and downs here and there for different stories because of risk dynamic. But big picture, EURUSD, you're looking way lower than 110. I'm looking at 1.8 now. So that's another, from current prices, that's easily another 500 pips lower in EURUSD. So that's why I was more aggressive on shorting EURUSD, and I will continue doing that. And as that's the path of mostly outcome and the least resistance for EURUSD, as well as we will move further into the year. So we covered that, and since we're talking about yield differential and we got the Bank of Canada interest rate decision coming up, let me show you something which is going to probably drag this video out a bit longer than I wanted to, but it's very important. So I'm going to start off with the US 10-year yields. I'm going to explain to you what the dynamic is going into the US yield curve. So when we talk about US yield curve, we're talking about the 2 10s. US 10-year yield started rallying because the news broke that the Fed will introduce balance sheet reductions. Basically, that means they will be offloading their bonds. If they're offloading their bonds and they're not going to be buyers anymore, then that puts upside pressure on the yields. And the yields kind of dropped off last week because of the dynamics and hitting some crucial levels like 1.9. But in my view, and let me take you back down to the daily, in my view, the US 10-year yield will top out soon, but not before hitting probably about, let's drag this down, about 2%. And my expectations is after the Fed meeting next week, that yields start rallying again. Not sure if they're going to be able to hit 2% next week, but that's the path it's very likely to take, to hit about 2% before leveling off. So why is that important? Because when I look at the 2-year yields of the US, it has a more or less same trajectory. So 2-year yields represent the rate hike path of the Federal Reserve. So if Federal Reserve starts or thinks about starting raising rates, the 2-year yields will reflect that way before, and also will drop again, like it did when they were cutting rates during the recession, so on and so forth. And last year it did nothing because the Federal Reserve wasn't inclined to do anything either. So now that the 2-year yields are moving higher, and there's still room a little bit for them to go to 1.25, that will create an incredible interesting dynamic for the US yield curve, which is this chart here. Let's find it. So this is our US yield curve, and let me just fix that here. So this is a US yield curve chart where basically it's the 10-year minus the 2-year. So now we know that the 10-year has got room to go to 2%. The 1-year has still got room a little bit more to go. Overall, that really means that the curve will continue flattening down the line. In the short term, it's very important to me what happens at this level, at 0.75. We leveled off at 190, and I spoke about this level, I think, in November. That was one of the reasons why the yen pairs slowed off. But now, going into next week is very important after the Fed meeting what the yield curve does. If the yield curve manages to climb back up and maybe even hit 1% over the coming month, great. We've got better levels to sell our risk assets from. If it doesn't and just straight start tanking, that's our that's gonna be about our new target. 0.5, 0.45 is a reasonable price to look at. All of this is important because when I look at the Canadian dollar index, and all of a sudden I see, wow, it's a picture perfect correlation. And you know why? Because the US yield curve is basically telling you what the cyclical, what the growth environment, the business environment is in the entire world. And Canadian dollars being a pro-cyclical currency, very sensitive to the business cycle, is gonna go with all the twists and turns of the US yield curve. So right now we're sitting at a very critical bottom here, and we might see jumps. But as I already explained, long term, this yield curve will continue flattening, and while Canadian dollar might find a little bit upside here and there, maybe oil starts rallying again, and it can find a bit more joy, the bigger long-term move is going to be one declining trend until we hit recession again, and then it can maybe pick up. But Canadian dollar is an all-out sell, and it doesn't even matter what the Bank of Canada does. They can be raising rates all they want. It's not going to make any huge difference because the business cycle has topped out last year about May, and it's going to continue declining. That's why you want to be a seller of Canadian dollar going down the line. Again, be mindful. You might see occasional rips and some seasonalities kicking in every now and then, but big picture, as we go towards the end of the year, it's going to be long declining move for the Canadian dollar, as it will be for the yield flattening. That's very important as it takes a lot of pressure off when you're trying to find direction. This is a probably one-sided move. There is very little in the way of changing direction. So we covered quite a bit. There's one or two other things I wanted to talk about as we are moving into the next week, and one of them is the S&P 500. It's obviously been dropping quite dramatically, and everybody thinking, oh, is this the end? And one of the reasons it's dropping is because there's a bit of a rotation going on, but also people are a bit worried about interest rate rises and balance sheet reductions. Some similar we had in 2018. And just to show you what it all looked like in the in the S&P 500. So in 2018, about September, October, that's when the Fed they already did a couple of rate hikes, and then they started balance sheet reduction. And from peak to the bottom, we saw about a 20% drop, which, funny enough, gave you a good buying opportunity. And I'm not expecting any difference from here this time. However, they haven't started balance sheet reduction yet. They're just starting to talk about it, which is some similar we had in probably 2017, 2018, where they talked about it, and then markets started stabilizing end of January. Beginning of February. However, there was also the trade war with China, and the tariff started, which was a whole another thing. Again, peak to bottom there, we saw about a correction of about 12%. I'm not really expecting the S&P 500 to do a lot more than that. So right now we're sitting about 8% or so. Maybe we can notch 40 to 60 thereabouts, which will leave us at about 11 or 12% again. I'm not really expecting way more downside than that until balance sheet reduction actually kicks in. It's really important, because once the balance sheet reduction kicks in, then that's when actually monetary conditions start tightening. Right now, monetary conditions are still loose. Fed is pumping money and all of that. There's no reason for this aggressive move. Another thing that I use for timing are the US GDP quarter-on-quarter estimates, which we will be having on Thursday next week. And if you can see these vertical lines, this every time we had the GDP read, it's not always going to be a picture perfect reversal, but it is markets that tends to calm down around the GDP reads. So that's something I'm expecting as well. Come Wednesday, Thursday, I'm really expecting the S&P 500 to calm down, and even if possibly the levels are good, start a new rally going into the following week. So just keep that in mind. I don't see this sell-off to be too dramatic. The real sell-off is going to come when the Fed starts actually reducing its balance sheet, and that's going to be furthermore down the line. So going into next week, we have a couple of things we're looking at. Starting on Monday, we have EU and US flash PMIs. The trend is down. Maybe we get to see some more downside on Euro, JPY, and all the other yen pairs. It really comes down to what the US yield curve does. So really pay attention to the yield curve, as that will give you an indication what all these other yen pairs can be doing. And it's really lucrative moves because it's one of the most volatile pairs, the yen pairs in the market. Going Tuesday, we have business climate coming from US and the euro. US is doing a bit better. Maybe euro will start picking up again. It's not going to matter a lot because we're going to be moving into the Federal Reserve meeting on Wednesday, which in my opinion is going to give US 10-year yield another new shove higher. So on Wednesday we're going to have the FOMC meeting at night, and I think that's going to start creating a situation where yields can pick up again. Or that's something I'll be looking forward to. Mind you, 80% of the time in FX space, so for instance, let's pick GBPUSD because we haven't talked about this today. 80% of the time after the Federal Reserve meetings or FOMC meetings, there's going to be some sort of a reaction, like it's going to go up, it's going to go down, it's going to do loop-de-loops. The following day, Thursday and Friday, the moves gets neutralized. So for instance, say the move is up, right? Let's say FOMC meeting comes and GBPUSD starts rallying. There's a lot of the times where you see the move gets neutralized and gets back down. Actually, the real move sometimes actually starts the following Wednesday, which is around New York time for Thursday trading. So keep that in mind when you trade the FOMC. I will be communicating that a little bit more detail when we're trading it live. So that's something to keep in mind, and keep a close eye on what the yield curve does, as that will be a main gauge. On Thursday we're going to have US GDP, and I'm hoping to see some S&P picking up pace on the positive side. And then Friday we are finishing with the German GDP, which is expected to contract, and I can't imagine that to be very positive for Euro either. However, I'm not really expecting a big breakdown or in EURUSD until the ECB meeting is over in 2 weeks' time. That's when traders will have a better idea to see if the bullish bets actually amount to something. Because right now, in all this consolidation, there's been a lot of euro buying. Funny enough, as we've seen in CFTC data, and for them to be able to hold those positions, they need the ECB to be hawkish in 2 weeks' time. Otherwise, they will close their positions, and we're gonna see lower levels extremely quickly. That's all I wanted to cover. A little bit longer video as it is covering 2 weeks. A lot to work with. Pay a lot of attention to the yield curve. And I think the best trades you're gonna find are probably around when you play around the edges and not start to trade in the middle of things. Try to either fade the ends when you think that the move is over, or start buying the breakouts. That's all I wanted to cover. Next week, Wednesday, I will be on Pepperstone Talk. There will be a few traders, me included, talking about where the outlook for GBPUSD and also some other trade ideas. I will be posting a link to attend the seminar under this video, so feel free to register and then join. I'm really looking forward to see you all down there. That's all I wanted to cover. I wish you very successful weeks, and I will see you again in 2 weeks' time. Bye.